Good morning and welcome to another closing bell market update here on this YouTube channel. Today I will summarize and explain the trading day of Friday, the 19th of May 2023. And here is today's agenda. We will start off by talking about Jay Powell signaling a pause at a meeting on Friday, Republicans walking out of debt ceiling meeting, sparking once again the fear that a technical default around the X-date could be possible. Regional bank stocks under pressure once again after Treasury Secretary Yellen said that more mergers could actually be possible. The fourth topic, incredibly interesting, investors. What we have seen throughout the week is investors actually moving to the long end of the curve. So, for example, 30-year Treasury bonds. Very, very interesting topic that we will cover today. And then we will also take a look at the week ahead, all the important events that are expecting us. Okay, first topic. Throughout the week, we got a lot of comments from Federal Reserve officials. Let me just kind of summarize it very quickly. Federal Reserve Governor Bowman, Cleveland Fed President Mester, Neil Kashkari, Bullard, Logan. All of those are Fed officials that have actually said kind of said that the current data, the current economic data, including the labor market data, the CPI, the inflation data, it does not support a pause at the next meeting, right? So they have said, given the data that we got throughout the past weeks, this data might actually mean that we have to raise rates by another 25 basis points at the next meeting because the data simply doesn't prove that inflation is on a sustainable downward trajectory. And a lot of these Fed officials, they have referred to inflation, to the labor market, for example. They said the labor market is way too tight for inflation to fall back to the 2% target. In fact, Federal Reserve President Logan, I'm not sure from which Federal Reserve she's the president of right now, but Federal Reserve official Logan, she said that job growth is more than twice what is required to keep up with the growth of the labor force. So there is this equilibrium here between job growth and the growth of the labor force, meaning that you have a very tight labor market, a low unemployment rate, and also obviously hence pressure on hourly wages, which gives consumer spending power, putting continued upward pressure on inflation. Now, Jay Powell has he sounded relatively, I don't want to say dovish, but he has the same opinion as, for example, New York Fed President Williams or Fed Governor Jefferson. What New York Fed President Williams and Federal Reserve Governor Jefferson actually said is that we don't really know the full effect of the previous interest rate hikes yet because interest rate hikes affect the economy, or monetary policy affects the economy with a lag. So we need to kind of wait for the full effect of these interest rate hikes on the real economy. So Jefferson and Williams, they have kind of signaled a pause. They said we now have to continue to look at the data. I need to mention here that also the other Fed officials, Mester, Logan, Kashkari, they have also said that the Federal Reserve continues to be data dependent. And what it essentially comes down to is the data that we get from here to the next FOMC meeting, including payrolls number, including CPI. So we will definitely have to watch out for that data. But Jay Powell, like I said, he also reiterated that the Fed is data dependent, but he very, very strongly signaled a pause. And here are some of the quotes, right, that I think are very important. So Jay Powell said that, quote, "We've come a long way in policy tightening, and the stance of policy is restrictive, and we face uncertainty about the lagged effects of our tightening so far, and about the extent of credit tightening from recent banking stresses." So he's acknowledging that monetary policy affects the economy with a lag, and hence you kind of need to wait now to really truly see the true effect of the previous interest rate hikes on the economy. He also said that, quote, "Having come this far, we can afford to look at the data and the evolving outlook to make careful assessments." So he is, in this case, referring to the data that is going to be released between now and the next FOMC meeting. So what he basically, and he also said that While the financial stability tools helped to calm conditions in the banking sector, developments there, on the other hand, are contributing to tighter credit conditions and are likely to weigh on economic growth, hiring, and inflation. So as a result, our policy rate may not need to rise as much as it would have otherwise to achieve our goals. Of course, the extent of that is highly uncertain. So he's talking about the effects of credit tightening on inflation here. The idea that credit tightening actually does a lot of work for the Fed in terms of bringing inflation back to the 2% target. Now, let me talk about the Federal Reserve arithmetic very quickly. What does Jay Powell define as sufficiently restrictive? Now, what Jay Powell basically does is he takes the nominal rate, he subtracts 3% inflation to arrive at a real rate of 2%, but you need to add to that credit tightening, the effects of credit tightening, and you need to add to that 2% real rate the effect of QT, the effect of quantitative tightening. It is hard, it is very, very hard to put a quantitative value to the effect of credit tightening, but you definitely know in what direction credit tightening is going. So you know whether or not it is contributing to bringing inflation back to the 2% target, but you don't know to what extent. So like he said, the extent to which these credit conditions, these tightening credit conditions actually help the Fed is uncertain. But they play a crucial role. And if Jay Powell knows that credit conditions are tightening, that might actually convince him to pause at the next meeting instead of hiking again. But essentially, if you square the circle here, right? You need to remember we're basically where we were before. We got all the comments from Federal Reserve officials saying that the data doesn't support rate a pause. We need to continue to assess the data that we get until the next meeting. Essentially, and the fact that Jay Powell is now kind of pulling back and saying a pause is very likely, basically, after the other Federal Reserve officials said the current data does not support a pause. Essentially, we are where we were before, because remember, the Federal Reserve is data dependent. So what it comes down to, whatever these Fed officials said, what it comes down to is, because the Federal Reserve is not the anchor to a strategy, what it comes down to is the data that we get from here to the next FOMC meeting. That will essentially determine if the Federal Reserve raises rates again. So very important when we look at the next, at the end of the presentation, at the week ahead, very important to remember the data is important. So the equity market, fixed income, they are going to respond to the data, right? CPI, a higher CPI than expected is going to put upward pressure on treasury yields across the curve, things like that. So it is very important for investors, because we have a data-dependent Fed, very important to carefully assess the data. And I like this picture here of Jay Powell. He's looking, it almost seems like he's looking at me very critically. I don't know. Okay, let's get to the next topic. This is kind of referring to this, right? What we can beautifully see here. There's one thing I actually wanted to mention here. Now, regarding this graph, what you can see here is market implied probability for the Federal Reserve's June 13 to 14 meeting. So how likely is it that the Federal Reserve will raise rates? Now, we have seen, obviously, the chance that the Fed will pause in May was at already kind of 90%, and it declined, just like we can ignore the probability of cutting rates. But the probability that it will raise rates has risen, right? Given the strong economic data, we got less progress on core CPI especially. So the probability, the market implied probability that the Federal Reserve raise rates has risen. However, what we have seen now is, after actually this meeting from Jay Powell yesterday, we have seen that actually before the meeting, around 40% believed was it 40? Yeah, it was 40. 38%. Around 38% of market participants believe that the Federal Reserve will raise rates. After the meeting, that value dropped to 18%. So investors definitely interpret this as a Federal Reserve pause at the next FOMC meeting. Very interesting graph. I believe this has not been updated actually for the Federal Reserve meeting, but it's probably, if you see that, going to be a decline here back to 18%. Down to 18%, the probability of raising from around 40. So we were here dropped to around 38%, dropped to 18 after the Jay Powell meeting on Friday. Second topic, fixed income. Beautiful topic, actually. What we have seen is investors actually moving to the long end of the treasury yield curve. Okay, my computer just crashed, but let us get right back to it. Second topic, very interesting. What we have seen throughout the week is that investors are actually moving to the long end of the treasury yield curve, meaning, for example, 30-year treasury yields. And of course, not only treasuries, just in general, long-term bonds. Let me give you some numbers here. 35% of bond issuance month to date, according to Bloomberg, has been 10 years or more. So what we're seeing is that money managers are actually increasingly favoring long-term bonds. The demand for long-term bonds is increasing. Why? Because investors expect a pause at the next meeting. They don't expect further rate hikes. You need to remember that when interest rates rise, when the Federal Reserve increases interest rates, the value of bonds, it drops very significantly. And especially, which makes a lot of sense, it is very intuitive, especially long-term bonds, they suffer a lot. They're very sensitive to interest rate hikes, meaning that if interest rates rise, you're going to see a significant drop in the price, in the value, right? This has been one of the many problems of Silicon Valley Bank, right? That they were forced to sell their assets, their long-term bonds, which have significantly lost value because the Federal Reserve has increased rates so much. They were forced to sell those assets at a loss in order to ensure deposits, right? That was one of the problems of Silicon Valley Bank and of the regional banks in general at the moment, or banks in general, right? Just some are suffering more compared to others, right? Due to uninsured deposits. I don't want to get into that now. But if you look at Apple, for example, they sold 1.25 billion of 30-year bonds on May 8th at a yield of around 4.88%. And when it sold those 30-year securities in July 2021, they yielded about 2.71%. So we have seen a significant increase in yields. Now the Federal Reserve does not further raise rates. That is expected. So, of course, the demand for bonds, for long-term bonds, significantly increases. Now, what you need to think about, let me give you some more statistic here, a historic statistic. If you look back at history, usually the Federal Reserve starts to cut rates 10 months after the last interest rate hike, right? And what we have seen is historically in every single one during every single time in history when the Federal Reserve was actually pausing, there was a rally on the bond market. People investing in bonds because they don't expect further interest rate hikes and they want to lock in those high yields. And also they have the potential to sell them right and make actually gain a positive return. They're able to sell them when interest rates fall again and the prices of those bonds rise. So like I said, so given yesterday's press conference of Jay Powell, in which he did indicate a Fed pause, I expect the demand for long-term bonds here at the end of the treasury yield curve to continue to increase. But essentially, it all comes down to the data that we get from now until the next FOMC meeting, and also fixed income, the bond market, they will respond to that data. So like I said, I continue to really stress the importance of assessing the data as an investor, because the data is what will essentially decide whether or not the Fed will raise rates. Now, if you think about it, a 25 basis point hike interest rate hike does not make that big of a difference. But you need to think about the psychological effect, right? Because what we have seen is in the past, actually, according to the University of Michigan survey, inflation expectations are at a 12-year high. Now, inflation expectations, they play a significant role because also if you look at the Fisher equation, the real rate is equal to the nominal rate minus the expected inflation rate. When inflation expectations rise, which is also very intuitive, when inflation expectations rise, actually, it will be much harder for the Federal Reserve to bring inflation back to the 2% target. So it is very important for the Fed to keep those inflation expectations anchored. Now, when these inflation expectations run out of control, the Federal Reserve might have to raise rates by 25 basis points in order to kind of get them anchored again, right? These inflation expectations, to make sure that they don't run out of control. So this is all things that you need to pay attention to when considering to invest into fixed income. Just continue to assess the data that is going to be released throughout now in the FOMC meeting. And you're perfectly at the right spot here at the Griepentrog Börsen News, stock market news as well, because we will cover all of that data and explain what it means for markets. Now, a quick quote here from Vishwas Patkar. Sorry if I pronounced that name incorrectly. She's head of investment grade credit strategy at Morgan Stanley. She said that, quote, many investors like long duration exposure because of the view that all-in yields are attractive and that the Fed is done hiking. Very important that the Fed is done hiking. So long end rates won't rise further, end of quote. If you look at this graph, you can see that these long-dated, high-grade U.S. corporate bonds, they were actually lagging. And because, like I said, rising rates undermine the performance of debt that's due later, because that debt is very sensitive to interest rate hikes. But especially the long-term debt is now attractive if the Federal Reserve actually does not increase rates further. All right, is there just a missing slide here? Did I forget about a topic here? No, we are now moving on to the debt ceiling debate. Oh, okay, my mistake. All right, Republicans walking out of debt ceiling talks. We know Joe Biden is in Japan right now at G7 meeting, and so he's actually not actively participating in negotiations over raising the debt limit. And what we have seen today, okay, in general, we have seen a lot of confidence about the debt ceiling throughout the trading day yesterday. Now, what I'm going to do very, very quickly here, if you let me just say S&P 500, all right? If you look at the performance of the S&P 500 yesterday, you can see that it was doing very, very well. Also, the DAX, for example, closing at a record high. So stocks were doing very well, but here around 11:05, a little bit later, we actually got the news that so I think this is actually, yeah, no, this is right. We actually got the news that the debt ceiling, that Republicans walked out of the meeting, and then there was a sell-off in the S&P, right? And it actually finished the day by in the red by 0.14%. Now, if you look at the day, the week, it finished the week in the green by 1.58%. So the debt ceiling debate has actually sparked a lot of optimism because we were making progress on that meeting over the negotiations, right? McCarthy said we might reach an agreement by the end of the week, and that has caused a lot of optimism among investors. But now the fact that Republicans are walking out of the meeting, and just look at this quote here, until people are willing to have reasonable conversations about how you can actually move forward and do the right thing, then we're not going to sit here and talk to ourselves. And this is a quote from Garrett Gaves, which is the Republican congressman from Louisiana, who is actively participating in the negotiations. So this has caused a lot of pessimism, a lot of fear that the Republicans and the Democrats might actually not reach an agreement. So like I said, yesterday, Kevin McCarthy suggested that a deal might be reached by the end of the week. And that optimism, right, that was gained from that comment is now essentially has been dealt with, right? We don't have that optimism anymore. Now, Biden will return on Sunday from his G7 meeting, like I said, and I expect that we will get more comments about the debt ceiling debate over the weekend, and this will certainly continue to move markets throughout next week. So very important event. Investors will be very focused on that simply because of the mere fact how detrimental a technical default would be on the US. So like I said, yeah, the major US indexes were performing beautifully throughout the day until we got the news that Republicans walked out of the debt ceiling talks. So an event that investors will continue to pay attention to. Will be very interesting because I expect us to make a lot of progress on this topic next week. Definitely a market moving event here. All right, another topic, regional banks once again under pressure. If you look at Pacific West, obviously Pacific West was suffering after the collapse, after First Republic was acquired by JP Morgan. Pacific West actually has a healthy balance sheet. Now they have reported that they have seen an increase in deposits in general, and also the share of insured deposits has increased, and that has actually created a lot of good news, right? The KBW Bank Index was up 7% this week at some point, which is a record increase during one day, basically. So we have seen a lot. The regional bank sector has gained back a lot of confidence because the balance sheets on the liability side, deposits as well as on the asset side, actually not doing that badly. So actually some confidence was regained in the regional bank sector. But now some pessimism was sparked after Treasury Secretary Yellen said that more mergers could be possible. So mergers like, for example, we have seen with JP Morgan and First Republic Bank. I don't know. Yeah, this is I pasted the wrong quote in here, but it's fine. So like I said, I was optimistic last week because we did see that the regional bank sector regained some confidence. But the US Treasury Secretary Yellen, the fact that she's saying that more mergers could be possible has sparked a lot of pessimism in the regional banking sector. As you can see here, Pacific West Bancorp down by 1.88% to 5.73. So that the fact that Treasury Secretary Janet Yellen said this today, I don't know. It kind of disrupts the fact that we were starting to rebuild some confidence in the sector. However, she also reaffirmed, quote, the strength and soundness of the US banking system, noting that it remains well capitalized with strong liquidity. And the readout, this was the readout from the US Department of the Treasury on Thursday, and the readout didn't actually mention anything about bank mergers. So I was thinking she was just simply warning that mergers could be possible. Now, she was in a meeting between JP Morgan CEO Jamie Dimon and Citigroup CEO Jane Fraser. And like I said, she said more mergers could indeed be possible, but the banking system is in a healthy state. Not only Pacific West Bancorp was in the red, of course, also the KBW Bank Index and also Western Alliance, they were all in the red. All right, let us kind of look at the week ahead. On Monday, May 22nd, by the way, Bloomberg computed this. Very good job once again. Just a great company. On Monday, we will get comments from Federal Reserve official James Bullard, Raphael Bostic, the Federal Reserve of Atlanta president, and also Barking. And it will also be the JP Morgan Investor Day. So two very important events. The comments, right, once again, will be analyzed, of course, here on this YouTube channel. It will be very interesting what Bostic, Bullard, and Barkin actually have to say. Tuesday, we will get the US S&P Global PMI Index. Very important data point here. S&P Global Purchasing Managers Index and also Federal Reserve official Logan, right, the Federal Reserve of the Dallas, the president of the Dallas Federal Reserve will speak once again. Now on Wednesday, we will get the Fed minutes from the last FOMC meeting. So all of these, right, the comments of federal officials, global PMI, and the Federal Reserve minutes that will be released on Wednesday, all of these have market moving potential. Then UK will be in the headlines probably on Wednesday. We will get comments from Bank of England's Andrew Bailey, right, the president of the Bank of England, and we will also get UK Consumer Price Index. On Thursday, first quarter GDP second reading, right, the adjusted reading, and we will also get once again jobless claims, right, which came in this week, actually came in below expectations. And then on Friday, the PCE deflator, very, very important indicator for underlying inflation for the Federal Reserve, another market moving data point that is going to be released here. We will get the University of Michigan Sentiment Index and personal income and spending data. Wow, a market moving week here. Very important data points. I'm so looking forward to actually analyzing that data. And I also hope that you enjoyed today's closing bell market update. Not really a closing bell update because it is 10:43 a.m. on a Saturday morning. But yeah, I hope you enjoyed today's stock market summary of Friday's trading day. And have a great evening.